The IRS is not waiting for tax season anymore. Right now, today, they are watching bank accounts across America. And the threshold that triggers their attention is not $10,000. It is not $5,000. It is $500. If you have more than $500 sitting in any bank account, checking, savings, it does not matter. There is a 2026 reporting rule that most Americans have never heard of, and it is already in effect. I am going to tell you exactly what it is, exactly what triggers it, and exactly what you need to do right now to protect yourself. Stay with me through this entire video because the part most people miss, the part that actually costs them money, is not at the beginning. It is in the middle. My name is Dr. Diane Marshall. I spent over 2 decades working inside the federal legal system. I have seen what happens when regular people, careful, hardworking, honest people, get caught off guard by rules they were never told existed. That is why I started this channel. Before we go any further, if you are not subscribed yet, hit that button right now and turn on notifications because the rules around your money are changing faster in 2026 than at any point in the last 30 years. And I cover every single one of them in plain English. No jargon, no legal confusion, just what you actually need to know. Now, let us talk about what is really happening to your bank account. For years, banks were required to report cash transactions over $10,000 to the IRS. That was the rule most people knew. Stay under $10,000 and you were invisible. That was the assumption millions of Americans operated under. That assumption is now dangerous. What changed is something called bank transaction reporting expansion, a policy push that has been building quietly since 2021 and has accelerated dramatically in 2026. The core idea is simple, and it should concern every single person watching this video. The IRS, working through the Financial Crimes Enforcement Network, FinCEN, has been pushing financial institutions to flag and report patterns of transactions involving amounts far below the old $10,000 threshold. We are talking about $500, $600, $800. Not one single large transaction. Patterns, repeated deposits, regular transfers. Anything that looks like income or looks like someone is trying to avoid looking like income. And here's what makes this particularly dangerous for ordinary Americans. You do not have to be doing anything wrong. You just have to look, to an algorithm, like you might be. Now let me give you the specific triggers, because this is where most coverage of this topic gets vague and unhelpful. I am going to be specific. Trigger number 1. Regular deposits just below a round number. If you deposit $480 every week, or $950 twice a month, or $1,800 consistently, the system is designed to notice that pattern. It is called structuring detection, and it was originally built to catch drug traffickers and money launderers who made deposits just under $10,000 to avoid reporting. The problem is that the same pattern, regular, consistent deposits below a threshold, describes millions of completely legal Americans, freelancers, side hustlers, people who get paid in cash, people who sell things online, people who receive help from family members regularly. The algorithm does not know the difference. It flags the pattern. Trigger number 2. Sudden increases in account activity. Your account normally sits quiet. Then one month you sell a car, receive an inheritance payment, get a bonus, or have a medical reimbursement come through. Suddenly, there are large movements your account has never seen before. That spike triggers a review, not because you did anything wrong, because the pattern changed. Trigger number 3. Frequent small transfers between accounts. Moving money between your own checking and savings regularly. Sending money to a family member through Zelle or Venmo frequently. Splitting payments across multiple accounts. All of it creates a data trail that modern IRS monitoring tools are specifically designed to analyze. Now, here's what I need you to understand before we go any further. This does not mean you are being investigated. It does not mean you have done anything wrong. What it means is that you need to know these triggers exist so that when you do receive a letter, a notice, or a request for documentation, you are not blindsided. And so that the records you need to prove your innocence are already in order. Now stay with me here because this next part is the one that surprises people the most, and it is the part that is already costing Americans money right now. If you use Venmo, PayPal, Zelle, Cash App, Apple Pay, you are already inside the reporting system, and most users have absolutely no idea. Here is what changed. Starting with the 2022 tax year and accelerating through 2026, the IRS lowered the threshold for third-party payment platforms to issue a 1099-K tax form. The old threshold was $20,000 in transactions and 200 separate transactions in a year. Essentially, only serious sellers got a 1099-K. The new threshold? $600. Total for the entire year. That means if you sold a couch on Facebook Marketplace for $300 and sold an old laptop for $350, you will receive a 1099-K. The platform is required to send it, and the IRS receives a copy automatically. It does not matter that you sold used personal items at a loss. It does not matter that you were just helping a friend and they paid you back through Venmo. The form gets generated, the IRS gets notified. And if your tax return does not account for it, that is called a discrepancy. And discrepancies trigger reviews. I have spoken with people who received IRS notices over $600 in Venmo transactions from splitting dinner bills and vacation costs with friends. They had no idea they were supposed to report it. They had no idea a form had been generated with their name on it. They had no idea the IRS already had a record that did not match their return. Now you do. Here is the one that I want every single person watching this video to understand deeply, because this is where innocent people accidentally commit federal crimes. It is called structuring. And it is illegal, even if every dollar you are moving is completely legitimate. Structuring means deliberately breaking up transactions to avoid triggering a reporting threshold. Here is a real scenario. You sold your boat. The buyer paid you $11,000 in cash. You know that $10,000 cash deposits get reported to the IRS. So you decide to deposit $4,000 one day, $4,000 3 days later, and $3,000 the following week. Problem solved, right? Wrong. That is a federal crime. It does not matter that the money was completely legitimate. It does not matter that you paid taxes on every dollar you ever earned. The act of deliberately splitting deposits to stay under the reporting threshold, even with clean money, is structuring. And structuring carries penalties of up to 5 years in federal prison and forfeiture of the entire amount. Banks are trained to spot it. Algorithms flag it automatically. And the IRS does not need to prove the money was dirty. They only need to prove the deposits were deliberately structured. The protection is simple. If you receive a large, legitimate sum, sell a car, close an estate, receive an insurance payout, deposit it in full. Keep the documentation of where it came from. Do not split it to avoid attention, because the splitting itself becomes the problem. Let me tell you about a man named Robert. Robert is 67 years old, lives in Ohio, retired school teacher, clean record his entire life, never had a problem with the IRS in 40 years of filing taxes. Robert started selling things on eBay after he retired. Old tools, collectibles, things he had accumulated over decades. It gave him something to do, and brought in about $800 a month. He never thought of it as a business. He never thought of it as income. He was just clearing out his garage and his basement. Then, one March morning, Robert opened his mailbox and found an IRS correspondence notice. He had received a 1099K from PayPal showing $9,600 in transactions for the year. PayPal had reported it automatically. Robert had never reported a dollar of it on his taxes because he genuinely did not know he was supposed to. The IRS was not accusing Robert of fraud. They were asking for clarification. But Robert, who had never dealt with anything like this, panicked. He hired an accountant. He paid back taxes. He paid a penalty. He paid the accountant. A man who did nothing intentionally wrong spent 4 months of stress and over $3,000 in costs because he did not know a rule existed. Robert's story is not unusual. It is playing out in homes across America right now. The difference between Robert before that letter and Robert after that letter is the same difference I am trying to give you right now: knowledge. Before the letter arrives, here is your action plan. 5 specific steps. Do these now, not after you get a letter. Step 1. Audit your payment app history right now. Open Venmo, PayPal, Zelle, Cash App, every platform you use. Add up your total received transactions for 2026 so far. If you are on pace to exceed $600 from any single platform, you need to be tracking that income and setting aside the appropriate tax percentage. Step 2. Separate personal reimbursements from income, in writing. If friends pay you back for dinners, trips, or shared expenses through Venmo, add a note to every transaction. Reimbursement: dinner March 4th. Split: Hotel Vegas. That note creates documentation that distinguishes reimbursement from income. It will matter if you are ever asked. Step 3. If you receive a large cash payment, deposit it whole. Do not split it. Do not stagger it across days. Deposit the full amount. Keep the documentation showing what it was for: a bill of sale, a contract, a text message confirming the transaction. That paper trail is your protection. Step 4. Check your IRS online account. Go to irs.gov and set up or log into your IRS online account. You can see every 1,099 an information return that has been filed with your Social Security number. If a platform has already reported income attached to your name that you did not report on your taxes, you want to know that now, not when they contact you. Step 5. If your side income exceeds $5,000 this year, speak to a tax professional. Not next April, now. A 1-hour consultation with a CPA who understands the current reporting environment costs far less than the penalties, back taxes, and stress of an IRS notice you were not prepared for. Before I close, let me bust 3 myths spreading fast about this topic. Myth 1. If I use Zelle, I am safe because banks do not report Zelle. Partially false. While Zelle itself does not issue 1099Ks the same way PayPal does, your bank still reports large or suspicious transaction patterns to FinCEN. And if your Zelle activity represents unreported income, the IRS can still reach it through other reporting channels. Myth 2. The IRS only goes after rich people. Completely false. The IRS's own data shows that audit rates for people earning under $25,000 have increased in recent years. The idea that small amounts fly under the radar is exactly the mindset that generates surprise notices. Myth 3. I already filed my taxes, so I'm fine. Only fine if every 1,099 that was generated in your name was accounted for. If a platform reported income to the IRS that did not appear on your return, the filing itself triggers the discrepancy flag. Let me bring it all together. The IRS monitoring threshold is no longer $10,000. Patterns involving $500, $600, and $800 are now flagged automatically by algorithms your bank uses every single day. Third-party payment apps, Venmo, PayPal, Cash App, are required to report your transactions to the IRS once you hit $600 in a year. That form goes to them automatically, whether you know about it or not. Structuring, splitting deposits to stay under thresholds, is a federal crime, even with completely legitimate money. Deposit large sums whole. Keep documentation. And the 5 steps: audit your apps, note your reimbursements, deposit whole, check your IRS account, talk to a CPA if needed. Those 5 things done now cost you nothing but a few hours. Doing nothing and finding out later costs you what it cost Robert. I do not tell you these things to frighten you. I tell you because you deserve to know the rules of the game you are already playing. The IRS knows them. Your bank knows them. The payment platforms know them. Now you know them too. If this video gave you something valuable, hit the like button right now and share it with one person in your life who uses Venmo or PayPal and might not know about the $600 rule. That share might save them thousands of dollars and months of stress. Subscribe to Alert America because this is what we do here. Every single week, in plain English, no jargon, no agenda. Just the truth about the rules that affect your life. Stay protected. I will see you in the next one.